Hey guys, Clint Coons here, and in this video, we're going to talk about choosing the right business entity for your new business venture. Okay, let's get started. All right, so here's the deal. About a week ago, I got contacted by the CPA in California who is working with probably 60 to 80 of my clients. And I don't know how they found him, but we work nationwide, so it stands to reason with the amount of clients that we have that eventually they're going to make it to certain CPAs. And people are going to talk about that CPA, and then their clients will gravitate towards them. So the CPA called me up and he said he had to talk to me about some of the structuring that my firm had been doing for individuals that he is now working with. And more particularly, what he took issue with was the fact he said that we set up way too many C corporations. Now, here's what he said. He's working with a recent client who just started a new business, and our firm recommended that they start with a C corporation. And the CPA told me that typically with a new business, he's going to recommend that they run their business as a sole proprietor, or they run it through a pass-through entity like a limited liability company that's disregarded. And the reason he said you need to do this, of course, is so that any losses, which typically a new business venture is going to have, you're going to have losses in your first year, or as he stated, possibly 2 years, can flow down onto your 1040 on your Schedule C, and you can take those losses against all other forms of income. And this particular client that he's talking about, well, his spouse was working, and he said, it's expected that he might lose $20,000 to $30,000 the first year, and we can take that loss on his tax return and use it against her $115,000 in income, and thereby reducing their joint tax liability. Now, that sounds great on paper, and many of you have probably considered when you're setting up a business the tax aspects of how you're setting up that structure. But here's the thing. The people that think this way, they miss what you and I are doing, and that is investing in real estate. And here's the problem with doing that. So when you start with that flow-through structure, as that CPA recommended to our joint client now, he's going to put him in a situation where it's going to make him really hard to borrow. And this is what I brought up. I said, if you go with the route you're going to go, just as you described, it's going to show a loss on his tax return. So then when you go in to apply for a loan, because as this individual stated, he wanted to start investing in real estate, how is that going to look to the lender? He's got a business set up that loses money. So if you're going to loan someone money, do you want to loan to people who don't make any money? No, you want to loan to people who can repay your loan. And here we have a new business startup, a guy that's just getting his business going, it's losing money, and he's not going to be able to invest in real estate. So here's what I like to do with people who are just starting out with a new business venture. Go with a C corporation. Now, you probably heard me talk about this before. You want to set up that C corp. All right, just like this, and you're going to be the shareholder. And what's key here is when you set up this corporation for your new business venture, make sure it's a C Corp, and you also want to make sure it has 1244 stock loss treatment. This is critical because, as I explained to the CPA, hey, I understand you're all about deductions, and a lot of new businesses, they never make it, and you want to make sure you can capture those deductions against your income. Hey, we've got you covered. But you see, I want to do more than just think on taxes, because as a CPA, you're a hammer and everyone's a nail. But I understand there's more out there, and when we're looking at a client like this, I want to ensure they still get their taxes. If they want to write it off, we can still get that for you, but I want to make you look good to lenders. So here's how it works. A C corporation. Nothing flows through to this individual's 1040. So we could lose $25,000 in this company this year, and an underwriter will never know that. So if this individual went to apply for a loan, what they're going to see when he turns in his 1040 is going to see that $115,000 his spouse is generating from her job. No income from him, that's fine, but they can qualify on that $115,000. If they had set it up the way the CPA was recommending and they lost $25,000, that's going to be a $25,000 loss there, and it's going to bring them down to $90,000 in income. They may not qualify. Plus, they're going to know that this guy's running a business that loses money. C corporations lock that loss in up here. No one finds out about it because it doesn't flow through to your 1040. So for new business ventures, if you're starting something up, go with the C Corp. If you're a real estate investor, don't have those losses flown onto your tax return. And as I stated, with this 1244 stock loss, have your cake and eat it too. This is what we're going to do here. If you decide that you want to close this company down because it just didn't work out, nobody wanted to buy your coffee, I get it, it happens. we can deduct this on your 1040 at that point in time. So in the future, you're like, well, I got my deal, I'm closed, I'm engaging in a BRRRR strategy, so I'm not going to need to qualify for another 2 years. Heck, we'll dissolve that company out and all those losses will hit your tax return and you'll be able to pick them up against your spouse's income up to $50,000. You see, we can get you protected both ways. So when it comes to starting up a new business entity, seriously consider using a C corporation. Keep those losses off your return so you can borrow more money and work with underwriters to get those deals done so you can invest in real estate. Hey guys, if you like the channel, pound the subscribe button, pound the like button, but be sure to come back next week. We'll have another great video for you on tax and asset protection planning for real estate investors.